advisor. I am president of Capital Consulting Group, or CCG. CCG consists of myself, of Chief Investment Officer Tom Fox, who you will hear from in a few minutes, financial advisors Dan Oshman and Rana Grant, and then our client support team of John Knutson and Marilyn Westmark. Together, our goal is to help our clients make their next financial decision, and the one after that, a good one. We do that in two primary ways. One, personal wealth planning. We can help you see your entire financial situation, both today as well as every single year into your future through our personal wealth planning services. If you'd like to learn more about this, you can go to clearfinancialfuture.com and watch the 2-minute video. And then we also give our clients' life savings the attention it deserves. We do this through our process called Smart Mix. Smart Mix is our personalized portfolio solution for individual investors. Whether you have $25,000 or $25 million, Smart Mix is our process for helping you get and stay invested right. If you'd like to learn more about this, you can visit the webpage at www.smartmixportfolios.com. I also want to extend a very special welcome to all of our existing clients. Thank you for taking a few minutes out of your busy schedule to be here with us. Of course, we do this call just for you. We want you to be in the know. And so we host this call on a monthly basis. We are online only today. We're going to be online only again next month. You can mark your calendar for 11 a.m. on December 15th. That is on the website. If you'd like to get a reminder set up for yourself, you can go to the website and do that. And then, of course, that will be recorded and live on the website for you to view later if you're not able to join us. If you are joining us today in the recording, also want to welcome you. We do appreciate you taking the time to be here. If you have any follow-up questions, feel free to email me directly later on. We would love to circle back with you. Additionally, every Monday morning at 9 a.m., I broadcast live on our website. I also now do it on LinkedIn, YouTube, and Facebook as well. Short little 3 to 5, sometimes 8-minute recap of what's going on in the markets. And I encourage you to plug in if you would like to kind of cut through all the emotion that is out there and stick with the facts. I do then later on that day, 3 p.m. Central, send out an email linking back to that recording. So again, if you can't join us live, the recording is available. If you're not getting this email and you would like it, you can subscribe again at our website, investwithccg.com. All right, so today we're going to hear from our Chief Investment Officer, Tom Fox. Tom is going to review where we are in the markets. He's going to talk about the headwinds. He's going to talk about the positives, and then he's going to talk about kind of the outlook for the balance of this year here. Ultimately, this is your opportunity to kind of look over our shoulder, get an idea what we're seeing in the markets and the economy and what we are watching out for. Tom spends all of his time more behind the scenes doing market research, due diligence, running different analyses, really focusing his attention on the economy and the markets. He's got over 35 years experience building investment strategies. He's got an impressive long resume, as you can see on the screen. Tom's message today is one that I look forward to more than just about anything all month. And so with that, I am going to turn it over to Tom. Bring you in here, Tom. There we are. Good morning, Tom. Welcome.
Good morning, Eric. Good morning, everybody. It's honor and privilege to be with you today. And I'm very excited to share with you our outlook. And we've been doing this every month all year and even last year. And we've not been 100%, but we've been pretty accurate in terms of our forecasts. I don't think anybody's 100%, but we've been getting it right most of the time, which helps our clients. So this slide I put on first, because as we go forward to the rest of the year, and this has been the key, we've been saying it for a few months, the key to the direction of the stock market is dependent upon where inflation goes. Does it come down like a rock, or is it coming down like a feather? If it comes down like a feather, that's not good. That means the Fed has to even become more aggressive or maintain their hawkish decisions longer and maybe more severe. But if it comes down like a rock, that's a game changer. And we think that a game changer has begun. And we'll talk more about that in the coming slides. But this is the key, the whole key, how fast inflation comes down. Now, there's plenty to worry about. I know what other strategists are saying. We're not ignorant to a lot of the negativity and bearishness that's out there. And so I've just listed a few of the items that others are saying. And, there's many people, they're very intelligent, very good at what they do. And in my career, long career, I've never seen so many investment strategists with different views. So we have one view. We hope our view is better than others, but I respect all the other views out there. And so we look at those, we look at all the negative potential things that come our way and so forth. So here they are. We just had a CPI, soft CPI this month. And some of them are saying, well, that's not going to change a thing. And the reason is because the Fed has stated over and over, they want a string. They want multiple softer inflation numbers going forward. So they don't see any change that will go on unless we get that longer string together. The other thing they're saying is that corporate earnings will enter a recession. Now, they said it would. We were hearing some strategists talking about corporate earnings in the third quarter that would fall 20% or go into a corporate earnings recession. That did not happen, but many believe, well, it's going to happen in the fourth quarter. Many were wrong in the third quarter. We said there would be no corporate recession this year, and we'll talk more about that and give you some charts on where earnings are going. Another negative comment is that layoffs are increasing, especially in the technology companies. We're seeing more and more layoffs coming, but actually layoffs could be good because that's what the Fed wants. They want employment, which has been incredibly strong. We've been at 40-year lows. They want that to weaken, so they know that softer economic and inflation and so on will start to come down if we get worse employment numbers. So actually, that could be a blessing in disguise, especially, but not so for the people that are laid off. They also believe that the PE ratio will contract soon. They've been saying that for months. It did not contract, but it's in a relative valuation that is decent. We're not expensive, we're not cheap, but we're in a kind of a sweet spot in the middle. And we do not see that that's going to come down much more. Of course, corporate earnings are a big part of that. And so many believe we're in an economic recession already, or we're going to be heading into one. We do not see that for 2022. Now, next month, I'll be talking to you about our outlook for 23. That will come next month. So we're just talking about 22 this year. So overall, I would say there's deep skepticism among investment strategists. Many are expecting lower lows. We are not in that camp. We are actually more bullish than we were last month. And we're going to discuss why on the next slide. So there are positives. You go, is there any reason I should be buying stocks or stay in stocks? And one, it's a big one, is that all the signs are pointing to now that inflation has peaked. Also, the October CPI, which came in last week, was at a soft 0.27% for the month. That's a game changer. If you annualize that forward, we're looking at a 3.5% inflation rate. So that we believe this soft number is a game changer. Why? Because for the first time, the hard data, the CPI, synced with the leading indicators or the soft data. So now we're seeing that the Fed doesn't have their back up against the wall, counters a hawkish view. And the next thing is that the Fed now has a measurable progress in inflation. That's been one of their complaints. They haven't seen anything. Well, we believe the October number, which just came out last week, is a game changer. In addition, this week, the PPI, which is wholesale prices, which eventually end up in the retail prices, confirms the CPI. That number came in better than estimates. We'll look at a chart on that. And then also we have midterm seasonality. Every time the midterms are over. The next year, the stock market has done well. We'll look at a chart on that. So there's a seasonality play here that's positive, and the economy is expanding. We haven't gone into recession. If you look at a lot of the leading numbers, they haven't gone into a recession yet. Many have said we're already in a recession, but the GDP came out and said in the third quarter is not a recession. So we have not entered a recession yet, although it is slowing, which is what the Fed wants to see anyway. So what this means is that softer inflation that we saw in October's numbers means that there is still a possibility of a soft landing. That was diminishing, but now that kind of revives the potential for a soft landing instead of a hard landing into a recession. So we'll see how that goes in the next CPI print, which I'll be talking about. Another thing is the employment numbers are still strong, although layoffs are increasing, which is what the Fed is looking for. And again, no earnings recession yet. And this is a big one. We've been saying this for months. Less bad news means really good news for stocks, or even good news, and it will be amplified to the upside. We saw that when we had a major move after the CPI number came up, with the S&P rising almost 6%. So we can see that any less bad news or even good news, there is so much cash on the sidelines, this market will move faster than anybody can anticipate, because it's like having a beach ball under the water. And I don't know if you've been out with your kids or grandkids and you got the beach ball underwater, you let go of it, boom. That's the kind of opportunity there is for stocks.
I think that's worth reiterating, just kind of pointing a little bit closer at, Tom, is that less bad news and stocks will be amplified to the upside. A lot of our clients and viewers here don't watch the markets every day. So go in a little bit deeper on what happened on Thursday last week. What happened that was a good example of what you meant by less bad news amplified to the upside?
Well, the October, so in November, they announced October's CPI number. And what happened, the beach ball was under the water. And what took place was there was a surprise. This was good news. There was a surprise soft inflation number. And everybody was expecting higher inflation for the CPI. So it beat expectations. It wasn't spectacular, but it was better. And what happened was the beach ball was let go because there's so much negativity out there that the stock market roared up, historical roar. It went up almost 6%. I think it was 5.7% in one day. That's how fast, when you have so much money on the sidelines and you have so much bearishness and negativity, it does not take much to release the beach ball from underwater.
It's a great analogy. Thank you.
All right, so we're going to look at a number of charts about earnings because there's a lot of negativity on earnings, corporate earnings. So let's look at it. So this is the results, not 100%, but pretty close. I think it's 91%. But if you can see the circles, you can see the results so far of the no earnings recession for the third quarter. And because 70% of the companies beat expectation, now that's below a long-term historical. Much of that was driven by energy, but still 2.8% surprise to the upside for earnings. And if you look at the right chart, that's revenues. Even 71% of the companies out there beat the revenue estimates. And that also had about a 2.8% surprise to the upside. This is not an earnings recession or even revenue recession. Many people thought that was coming. We said it would not. And this bears that out. So here, this is interesting because now the analysts for the fourth quarter are expecting only a 0.1% drop in corporate earnings for this next quarter. That's not a 20% drop. That's not a 15% drop or 10. That's not a recession for earnings. And look at 2023's now forecast, a positive 4.9% for earnings. This was on CBNC. And you can see the headlines at the bottom. Stocks jump after a tamer than expected PPI report. So remember, the CPI came in last week, the PPI came in this week, and we'll look at more about that. Now, this is an interesting chart. What it shows is 13 out of the 16 times the stock market bottomed before earnings bottomed. So the stock market is always looking forward. It's always discounting the future. And when you're in tougher times, it discounts what's going to happen even further out. When you're in a bull market, it may be only discounting 6 months. But when you're in a bear market, it's looking at a year and a half. Where are we going to be in a year and a half? And the prices adjust to that. But you can see the circle at the bottom that on average, on the average is 12 months, the median's 11 months, that earnings, the stock market will bottom well in advance of earnings bottoms. Now, that's an amazing chart because it shows that stocks start moving well before the bottom of earnings. Another positive for corporate earnings is the super decline we had, 6-day declines in the US dollar. And this is going to support corporate earnings, especially companies that do business overseas. It's good for stocks, especially global stocks. And you can see that we had a record downturn in the more recent years of what I think it's 5.9%. And so typically when you get that kind of a move downward, it will continue down for the next 3 to 6 months. This is good for stock corporate earnings. Now, I just want to talk briefly about the 60-40 portfolio. Many people and financial advisors and others have put their clients in a 60-40, and that's historically been a great portfolio. However, bonds have done about as bad as stocks have this year. So it was an unusual year, and where the 60-40 portfolio did not work. Now, you may not be able to see this, but it shows all the times that the 60-40 portfolio was negative. And the 64 portfolio return is the dark blue. So it picks out historically all the way back to the Great Depression. And you can see that the 60-40 portfolio is worse than the 2008 financial crisis. Bonds had no buffer, but in 2008, there was a buffer. But this year is very different. So many are saying, well, is the 60-40 portfolio dead? We don't think it will be in the future, but we think it is right now. Now, our 40% and all our strategies or whatever is dedicated to fixed or alternatives is actually positive this year. That's very unusual because for example, through last week, the bonds were down 15%, and the same as stocks. So our 40 or the bond alternatives were up positive. That's very unusual. How do we do that? Because we moved out of bonds into alternatives. And we did that early last year, which was a great timing. We saw that interest rates were going to probably start moving up. So we started moving away from the fixed income universe and got into alternatives. And some of them did very well. So bonds provided no buffer. It's been a very difficult season for the typical financial planner or financial advisor's portfolios. However, we're doing really well. All right, here's another reason that we talked about the stocks going up, and that's the first year after the midterm, stocks go up. And we're going to look at the chart. So there is a seasonality play here, post-midterm elections. And it really doesn't matter if the Republicans win or the Democrats win. The average is around 15% of positive return the year after the midterms. So this is a lot of consistency. This is a very interesting chart because it's almost 15%, no matter if Republicans or Democrats get in. But what it means is a seasonality play in stocks that is very positive post midterm elections. This is an important chart. Now we're going to look at 1982. Stocks can move before the Fed. Now, this is probably more difficult to see this chart. I circled a couple things. One of the circles, you see a blue line and a red line. The blue line, remember, in the early 80s, there was higher inflation than we're experiencing now. And Volcker was the chairman of the Fed. And so you can see that the arrow, it says bottom, after it dropped 27%, you can see that the stock market bottomed in advance of Volcker saying, we're going to make a tactical shift. We're not going to be so hawkish. So the stock market had already moved. And very shortly after he said, hey, I think we're going to make a tactical shift in our policy, it had already then just very shortly after gone to new highs. What happened was that the stock market erased 4 months. Erased in 4 months the entire 27% drop of that bear market caused by high inflation. We've been telling our clients that this will move in advance of the Fed. And so this is just another point we want to make. History is not exactly, but it's similar. So if this happens again, we can't guarantee that. But if this kind of move in the stock market happens before the Fed begins to make a shift in their policy, this would be consistent with what happened in 1982, which was a high inflation period. Now, what happens after the Fed stops? So the stock market's already began to move, most likely, but you can see when it that on average, and you can't see you can see there's a lot of positive numbers, but the stock market after the Fed stopped 18, 19, 36, plus 11, or minus 11, plus 21, 32. But the average is plus 15% after the Fed starts. But remember, in our previous chart, there's a possibility that the stock market moves in advance of the last Fed hike. All right, so let's look at economy inflation. We believe there's a new deflationary trend just beginning. We've been talking about feather or rock. We think it's moving from a feather drop and potentially could go to a rock. If that happens, this stock market is that beach ball. It's going to come up from underwater. So finally, we get a game changer, better CPI number last week. So in the CPI, you can see all the red, but half of the parts of the CPI are in deflation, 50%. And we think that's going to grow. But already 50% of the CPI are in deflation. This is good news, that the possibility of a continuation of better numbers as we move forward. So you can hear we're going to break out some of them. This is wholesale prices, the Manheim index, which shows they're falling like a rock. It's down 10%, 10.4% prices for the used cars. Now the CPI reported a plus 2%. That gap of what the wholesale prices are, minus 10, and what the retail was plus 2, that's going to narrow. So we expect that as we get more CPI data going forward monthly, that there'll be a narrowing of that gap of what they're paying wholesale and what the retail is. So we expect that could even turn negative. Another one that surprised in this last week was medical insurance falling like a rock. That's 48% annualized. It was look at that, 4% drop in 1 month. This is huge. So that's another big cost for families. And for whatever reason, I don't know all the reasoning behind it, but medical insurance fell like a rock. So we have used car falling, wholesale falling like a rock, and medical insurance. Now, remember, we said that the CPI was a game changer. Well, the PPI came out this week. That's why you had another rally. because they were expecting 0.4, but the PPI ended up plus 0.2. It was half the estimate. And even the core PPI was unchanged, yet they were expecting a positive 0.3. And they even downgraded September's numbers. The revised numbers also came down. This is a confirmation. These are wholesale prices. These are what companies are paying. What price are they paying? And then it ends up in the CPI, what we're all paying. But this is another confirmation that we're heading in the right direction. And we may end up in the PPI and the CPI falling like a rock. So this is showing that the services is the gold number. The blue line is goods. You can see it's falling like a rock. Services tend to lag. Remember, there was a shift from goods to services this year. Everybody wanted to get out of they've been in a quarantine. They've been in the COVID, at home more. Everybody wanted to go travel and get out. So their services is going to be a lagger, but we can see the overall direction. It's falling like a rock. The goods are. Now, JP Morgan, in their more recent global economic research, said this: inflation should encourage Fed moderation. So the new game changer, we believe, JP Morgan said this, that they believe, and you can see it highlighted, they should encourage moderation in the pace of monetary policy tightening. Now, does that mean the Fed's going to completely pause? Probably not yet, but it could mean that they're going to raise rates at a slower pace, and that the pause, and by the way, that the word pause in the investment community is changing. There's a lot of different definitions today of what pause means. Does that mean pause and raising rates at 75 basis points? Or does that mean a complete pause? So there's a lot of definitions there. But JP Morgan agrees with us that this should cause moderation. If the Fed moderates their extreme hawkishness, this stock market will go up. So here's our outlook. We've made some changes and we've become more bullish because the CPI hard data should continue to roll over, in our opinion. We only have one more CPI print this year, but we think if December's reading is similar to November's reading, we think that the stock market could rally into the year end. And we've been saying all along a bad first half. We said that at the end of last year and the beginning of this year. We said it would be a bad first half. We called a correction. It did go over the line into a bear market, but it's no longer in a bear market. But we said a good second half. And so far, the stock market is up over 6% in the second half. It was down 23 to 24% in the first half. That matches our forecast of a bad first half, but it's up over 6% as through yesterday. We'll see what happens the rest of this week. But we think the rally that's coming should exceed the June rally, the false rally. That lasted 23 days. The S&P went up 16%. We now have 50 or so days. We think this will be much bigger, and then it won't be a false rally because some of the soft data in the CPI is in the preliminary data is now reaching the CPI. And if it happens again in June, that's going to be another game changer. So those who remain bearish, if we're right on this, they're going to be forced back into stocks. If we get another good number in the middle of December, they're going to have to be putting more money. And remember, there's so much gunpowder on the sidelines. We think that that will force many back in, many institutions, many hedge funds, retail investors. They're going to have to go back in. So we dropped we had two scenarios last month. One is if the inflation comes down like a feather, that we gave a range of 3,600 to 4,000 on the S&P 500. We've sort of dropped that because we finally got a good number in the CPI. And we think it's going to be kind of the cockroach theory. The cockroach theory is this: is if you see one, you're going to see a lot more. Everybody, I hope you like that one. So we're forecasting a potential 4,400. We said that last month if the inflation starts dropping like a rock. Now, if the CPI backs off and goes up again or doesn't go down next month, we'll probably be back to the 36 to 100 to 4,000 on the S&P. But we think our whole mindset has changed. We're looking for a potential huge rally, bigger than the summer rally, and it may have legs.
And the S&P is just a hair under 4,000 right now as you speak. So that's 10%. Yeah. Very good, Tom. Thank you as always for that analysis. You covered a lot. You covered inflation, interest rates, elections. I mean, just a lot of information. So for everybody who's listening and watching, if you have any questions, we would love to field any questions for you. You can go ahead if you're on Facebook or if you are on LinkedIn, you can comment below and they will show up for me. Would love to field any questions for you. I do have a couple of questions that people have sent in ahead of today's message. One is are you going to be providing a 2023 outlook? And I think we got that answer already. So looking forward to that next month. Another question kind of around Powell and the Fed and interest rates. You know, they've got their policy of what they're doing with rates, and then they've got their voice. They've got their speech. We saw a lot taken back in after Powell's speech after Tahoe a couple of months ago. What do you think Powell's going to say next month when they come out and they're going to release what they're going to do on interest rates, and then most likely come out and talk, an hour later or so. Any thoughts there?
Well, only Paul knows what he's going to say.
Absolutely.
So I really don't know what he's going to say. I think a lot of it is the tone. The speech prior to Jackson Hole, he had a soft tone. And then many misinterpreted it. But they've been looking for some realization of some hard data that specifically the CPI, that it's going to get better. And so they got that in this last reading. Now they meet right around the CPI, next CPI. I can't remember if it's the day before or after, but I think it's on the 14th or 15th of December. We'll get the CPI and the Fed report. So if we get another soft number, I think the tone is going to change. Now that's a big if, because it could. I don't know. It may go up a little bit. It may go down. But if it continues in the same direction, like we're starting to see one cockroach and many other cockroaches, then I think his tone will change. Doesn't mean they'll stop raising interest rates, but I think they're going to lower the number. And remember, he said in his last speech that they would be data driven. Now they have to see more than one data point. We know that they need to see some string, but this is a good sign. They got one data point. If we can give them two, I think the tone changes.
I had an email just come in. Says, what are the implications of a possible real estate correction of 10 to 25% in the coming months, bringing real estate prices back to reasonable pricing? What are the implications of that happening on the equity markets? Will this be a detriment to a predicted rally?
Well, I think it would be to certain sectors. I don't. Well, I don't. First of all, I don't think they're coming down that much. One reason is the supply is still so low. There's not, supply demand. There's not that much supply of real estate. That will be a support from it crashing down. But I do believe the trend is downward and will continue that. I think we're going to have lower prices over the next 3 to 6 months. However, I think the sectors, it's going to be sector by sector. Home builders obviously going to be hurt. Anything to do with housing will be hurt, but I'm not sure that will actually spill over into other sectors of the market. We did remember the 2008 financial crisis. It did, but there are so many new government regulations and procedures before somebody can get a mortgage. So we don't have that overhang of what happened in 2008. It's hard to get a mortgage. You got to have good income. You have to have a lot of different accreditation that you didn't have to have in 2008. So the quality of buyers is much better. And so that the whole thing was to avoid a 2008. So we're not going to go, in 2008, everything went down. And that was impacted by this tremendous bear market in real estate. I think prices are coming down, but I don't think it's going to impact the overall stock market, except for the certain sectors that are related to it.
So kind of on that note with certain sectors, we've had some questions come in about, looking at the different strategies from wide moat to durable dividend to thematic, kind of those core strategies. And then obviously we've got recovery and super div and some of the tactical ETF ones. Looking at those different strategies, where if someone were to shift towards a certain strategy, what are your thoughts on what areas are going to do better moving forward, if you look out 6, 12, 24 months, just speaking on the different strategies that we're running.
Yeah, right now, I was just looking at all the strategies through yesterday. And of the 8 strategies, we only have one that's still in a correction or bear market. All the other strategies are either positive or out of a correction territory. Now, after today, it was 9. I got -9, -877 in some of the strategies. So I'm going forward. I think wide moat and durable dividend are your safest play. If you're younger and you got more time, maybe sprinkling in thematic. And of course, our tactical sector is only down 1.3%. Our tactical style is only down 8.77. Durable dividends down 8.71. Wide moats down 9.13. And then super dividends up 2.82. Recovery is up 33%. And fixed alt is up 1.16. So we have 3 positive, 4 that are not in a correction anymore. The only one that's been hit hard, that's down around 20, a little over 20%, maybe after today more, is the thematic. If we do get into a bull market, thematic will probably outperform. But I think all of them will do well. So I think quality, the Warren Buffett wide moat, that's quality. Durable dividend, quality. That should be your core, if not all your portfolio. And then if you're in maybe an IRA, I think the tactical strategies are nice because they trade more and you don't have the taxable repercussions if you're in an IRA or a non-taxable account. So those are doing really well. So I think thematic is the wild card, but I've noticed over the last 3 months that thematic has been outperforming the general market, the total market, U.S. stock market. And it was 7% behind. Now it's closer to 3.5. Now it's maybe 4% today after today. Target came out with bad numbers and bad forward look. Even though retail sales beat the estimates, it's interesting. Target said that a lot of the reason they're a big factor in their earnings coming out less than expected was corporate theft. With organized crime, people are stealing, and Target estimates that they're going to lose $600 million this year because of theft of their goods from out of the stores. And this is a huge problem. I think the number is 63 or 68 billion of loss from people stealing out of stores. And that's a product of the economic condition we've been in and the high inflation numbers. People are taking stuff out of the store that doesn't belong to them. I was surprised by that number. It came out today. That's something that's fixable, I believe, but it is a big problem, organized crime. And but I think that I would have definitely wide moat or durable dividend or both, durable dividend at your core. You could even add tactical style sector, depending if it's taxable or not. And super dividend, if you're looking for, that's up 2.82%. If you're looking for higher income from the dividends, you could sprinkle some of that in too. Another client recently was asking me that, and so how should we allocate? And it is up to you, Eric, how that goes. But they had wide moat, durable dividend, and then they had super div to just add a little more to the dividend. They didn't have thematic. So I would say thematic should probably point to the younger people that have more time.
Yeah, that's a very good reminder for everybody listening. Is that at the end of the day, the allocations should be a one-on-one conversation with your advisor. So whether it's me or Dan or Rana, we definitely want to have these conversations one-on-one, given your unique situation. One of the things that has come up a couple of times in some of my conversations is looking at, recovery up 30-some%, thematic down quite a bit. The tendency is to want to chase those returns, and we definitely don't want to do that. Just because something performed one way in the past doesn't mean that it's going to perform a certain way in the future. And so I can't stress that enough. Obviously, no changes are made to your accounts unless we do it. Your advisor does it, but a good reminder that everything that Tom said, we want to have a one-on-one conversation, and that is part of our personalized approach that we offer here, is to do that. So a good reminder.
Thematic has the highest potential, but it's the higher risk. And if we do get a bad number, let's by chance in December's announcement for the CPI, that won't bode well for thematic. If we do get a good number, it could really pop up a little bit faster than the others. They're all going to go up. It depends on your risk level. And of course, Eric and the other advisors are the only ones that can help you through that. But you're right. Because the thematic was up over 60% last year, or was it 2 years ago? I can't remember. 2020, I think. So it was up big, and that probably is a warning sign. That's hindsight, that maybe reduce your exposure there, and focus more on the core strategies, which are durable dividend and wide moat.
Very good. All right, let me check a few spots here. Any more questions that may have come in? Nothing in email, nothing posted, no comments. All right, last chance. If you have a question, please feel free to post that below the video on Facebook or on LinkedIn, or you're welcome to email me. Would love to present that. If you're watching this in the recording, of course, as always, don't hesitate to email me directly. Would love to follow up with you. Would love to get any answers to any questions that you have. But I think that is going to close us out for today, Tom, unless you have anything else that you want to add.
No, thank you for listening, everybody, and stay the course.
Stay the course. All right. Well, lots to look forward to. If you guys are here in Minnesota, it's cold and snowy and the roads are a mess, so be safe out there. If you're not here with us in Minnesota, probably better for you these last couple of days. So thanks again, everybody. You all have a wonderful rest of your day. Thanks, Tom.
Thank you. Take care.